Hi, and welcome to the Eagle City Multifamily Show, where we talk all things apartments and we get into real estate, commercial real estate, and some other topics at times. But today, I want to talk a little bit about 2024 and the current real estate market. And before I go any further, this is not legal or financial advice. It's simply sharing what we do, trying to help others with real estate education and investing education so you too can get better at investing your hard-earned money into something that will build up over time with or without you doing effort in that investment, right? And that's what we do. We put our money into an asset class like real estate where it gains value over time. Part of the Eagle City team is Asif Kumar and Dr. Sanjeev Mal and myself. And we purchase and operate apartments and provide a better than average return for ourselves and our investors. Hopefully, that's the mission. So a couple of things I want to talk about today is interest rates and real estate, like home buyers and home sellers. It takes both for transactions to happen. Here in a post by the Wall Street Journal, it says federal officials say rate cuts could be needed next year to prevent over-tightening, right? It doesn't say they will cut rates. It just says rate cuts could be needed. I've heard both ways, both sides. Maybe some rate cuts in 2024, maybe not. We don't know. I think the Fed has a great idea, but whether they tell us or not, we have to wait and see. Central bank must make sure we don't give people price stability, but take away jobs, says San Francisco Fed president. So we do one thing and it causes other things, right? We try to help one thing and it causes some other negative effect. There's always positive and negative effects, right? And so let's take a look. A Federal Reserve official said it is appropriate for the central bank to begin looking ahead to lowering interest rates in 2024 because of how inflation has improved this year. So they raise interest rates to slow inflation, they say. Then interest rates makes borrowing cost more. San Francisco Fed President Mary Daly said her outlook for interest rates and inflation was very close to median of projections from 19 Fed officials last week. Most of them penciled in at least 3 rate cuts next year amid a faster decline in inflation than anticipated. We're acknowledging progress when progress is there, Daly said in an interview Monday. That's like today, right? Today is Monday, December 18 of 2023. Some changes happening in the past year and in the coming year, I think. His comments sent investors in interest rate futures markets to increase their bets on earlier and deeper rate cuts next year. Daly said it was too soon to speculate at which meetings the Fed might change this policy stance next year. Right now, I'm really focused on how well things have evolved in 2023, she said. While much of the initial decline in inflation this summer stemmed from supply chain healing, more recent declines appear to have been driven by a cooling in demand-driven component, she said. A model maintained by San Francisco Feds suggests 2/3 of the decline in core inflation had been related to changes in demand. To me, that's a material development, said Daly. That means we have monetary policy working. Anyway, that's a little bit on inflation and rate cuts, on what to expect. And here's another piece that I want to bring out of the Wall Street Journal. And this, I think, was pretty recently, December 17, which was Sunday, I think, like yesterday, like a day before, on this December 17th of 2023. Home buyers are ready to buy, but sellers aren't selling. Now that could be a problem, right? Owners are feeling too fond of the low interest rates on their existing mortgages. The lowest mortgage rates since the summer are starting to lure frustrated home shoppers back to the market. The problem is that few homeowners who have locked in much lower rates appear ready to sell. Home sales this year are tracking to be the lowest since at least 2011. But as mortgage rates retreated from the nearly 8% in October to below 7% last week, buyers are responding. Mortgage applications have increased for 6 straight weeks on a seasonally adjusted basis. Real estate agents say that they expect more buying activity in the new year after home shoppers return from a break over the holidays. Home buying affordability, which hit the worst level in decades this fall, is improving. The typical housing payment for a buyer purchasing a medium price home with a 20% down payment was $2,503 in the 4 weeks ending December 10, the lowest level since April, according to real estate brokerage Redfin. That buying appetite is poised to grow further, owing to the recent retreat in mortgage rates. According to Freddie Mac, the average rate on a 30-year fixed mortgage has declined for 7 straight weeks, falling to 6.95% as of December 14, after hitting a 2-decade high of 7.79 in October. The most significant constraint is the shortage of homes on the market. Many homeowners who locked in low mortgage rates in recent years are unwilling to give up those loans to take on different mortgage at a significant higher cost. That makes sense. I think that's sort of like a hedge against inflation, have low interest rates locked in. After a boom, excuse me, in home purchases and refinances when rates were near a bottom, more than 32 million homeowners have mortgage rates below 4%, according to the Intercontinental Exchange. Homeowners' unwillingness to sell their homes because they don't want to let go of their low mortgage rates is keeping home prices near record highs. Mortgage rates would need to fall another percent point or more to entice many homeowners to sell, economists and real estate agents say. So that's a little bit about the median home. And the reason I look at homes, like single family homes, like I was just looking at, is because that affects our apartment renters, right? When it's harder to buy a home, more people move over to apartments instead of buying a home. Maybe they rent until they can afford a home payments, or maybe they move over to renting apartments and maybe they remain apartment renters, right? Because there's lots of options with apartment rentals. They can do an A class, a B class, a C class, right? Depending on what they can afford and what luxuries and amenities they want. And they also are not stuck with a home loan, right? If they want to move, if their job takes them somewhere, or they simply want to move to another town or another out of state or out of the country, they can do so without having to market a house, right? And a lot of the wealth advisors say it's a smart idea to rent for a lot of people for various reasons. And I know there's good ways of doing both renting and owning, so I don't have a strong bias. It depends more about what you want to do with your life and your financials, whether you want to rent or buy a home. But I do know it affects a lot of people when it makes it harder for people to buy and purchase a house, and the gap between the mortgage payments with the taxes and insurances and all of owning a home go up, and the gap gets wider and wider from renting to the payments of owning your own home. So those are a few thoughts for today. And if you would like to get in contact with myself or my anyone on my team here at Eagle City Multifamily, please call or text or email, or you can even jump get on my calendar for some one-on-one Zoom call to talk about apartments and investments, deals that we may have coming up in the near future. And don't forget, good things happen over a cup of coffee sometimes. My Phone number 903-951-7552. You call and text on that number, and you can also book time on my calendar at, if you simply Google chatwithherb.com. That's like ChatWithHerb.com, which is chatwithherb.com, and book some time on my calendar. Go ahead and do that. Or you can respond to our Facebook, Eagle City Multifamily Facebook page, or my personal Herb Cult Facebook page or YouTube channel. And you can also reach me at my email, herb@ecmultifamily.com. So would love to talk with you and let you know a little more about what we do in apartment investing.